Hi, and welcome to Charting the Second Half, a Stock Charts Mid-Year Perspective. I am your host, Mish Schneider, and we have an full-packed session here today as I took the task very seriously and really wanted to think a lot about what could happen in the next 6 months given how many times the word unprecedented has come up in the first half. So what I thought would be the most organized way to do it was to look at it in terms of megatrends. So a megatrend can be something that just started, like for example, work from home and Zoom, or it can be something that's actually relevant no matter what the age is, like for example, geopolitical strife. And so we're going to take those 5 that I think could be the most relevant for the second half and then whittle down, obviously with charts and actionable information. So the 5 that I'm going to cover today with you will be 1, what's going to happen during the presidential election. 2 would be sectors to watch for the second half of the year, plus the inevitable rise of cannabis. We'll talk about that. I have talked in the past about emerging markets and China, so we're going to look at that again. The Fed and the US dollar, a huge influence on what's going to happen over the next 6 months. And of course, those of you who have listened to me before knowing that I've been talking about stagflation, that's going to come up again. So let's start with the presidential election. If Trump or Biden wins, how will the economic modern family react? So what I decided to do was use my economic modern family, which is something that you also have all been introduced to, because it really is the best overall macro picture. And I'm going to be looking at all charts that are weekly charts. Now, from an overall perspective, the Trump administration has been relatively good for the market. In fact, if you recall, when he was first elected in 2016, overnight, there was a big crash right after the election results, and then the market did nothing but rally throughout through 2017 when he took office. And so there is reasons for that. He has been big on rolling back regulations, lowering interest rates to 0, although that's with the Fed, but it's been greatly influenced by him, and then also really lowering the corporate tax rate. Now, Biden wins, we're going to see a different reaction. We may see some of the social injustice marches that we're seeing in the protests diminish somewhat, but at the same time, the market is already worried that if Biden comes in, that taxes will go up and deregulation will go back to regulation. So what we're going to do is put on a little crystal ball here and see what the modern family might have to say. So we're going to start with the granddaddy of the modern family, and this is IWM. So this is the small caps. And by the way, last week, the small caps actually had a reconstitution. So there was a bunch of stocks that either moved out of the whole Russell 2000, 1000, and 3000 or moved into it. So that might be something interesting to look at another time. But in the meanwhile, looking at the weekly chart, there's a couple of issues that we can give a pretty good idea of what might happen as we go forward. So right now what you have here is a double top. The double top going back from 2018 into 2019, 2020. However, that double top broke down with a sort of a neckline here. You know, we've had a couple of fits and starts, and then we had this huge dramatic move down. So some might say that at this point that double top is negated. So what I'm seeing here right now is that after this huge move that we had from the peak to the crash, that we've come back more than 50%, and we're sitting here on a weekly basis consolidating. So if we're going to take the second half starting, say, after the July 4th and into July and August and September, I actually do believe that the situation we have going on right here looks more bullish than bearish, even though we are pointing down on the slope of the 50 and have a pointing up slope on the 200-day moving average right here. But if we go down here, it's really been in line on the performance of par with the SPY. And then, of course, the real motion indicators, those are the ones that have been the weakest on the weekly chart. So essentially, even though it looks to me like it has corrected from the big move up, and now is consolidating sort of at this midpoint, it puts us in a very interesting situation. So If you wanted to put numbers on it, I would say right here we're smack dab in the middle, and that's why the market's been so choppy. But if we look at 150 as the area to cross, then I would see no reason, regardless of what you read, why this wouldn't go up. And again, on the flip side, if it breaks down under like 133, which by the way on the daily chart is where the 50-day moving average is, then I think we can see some messy time. Now, what would be very frustrating is if we stay in this range between 150 and 133 for another several weeks, and that could happen. But July generally turns out to be a good month for the market. I see that we will see some kind of a swoon as we get closer to the election. So what I would be doing right now is be buying the dips against the bottom of the range and trying to sell the rallies against the high of the range until we see some kind of a clear signal. So I'm looking at maybe September, October is when we start to see, perhaps, especially if Biden continues to lead in the polls, it break down and take another test down to close to the 110, 120 level. Do I think the market is going to crash below what we saw during our March lows? No, I do not believe that. So I think whatever swoon we have, as we get closer to the election, by the time we get to February 2021, no matter who is in office, I believe that we're going to see a tremendous opportunity to buy stocks that are at much clearer fair value. But we have to go through sectors because that's just the general small cap stocks, and that includes value stocks. We're going to take a look at the growth stocks in the small caps, but this is Granny Retail XRT. Now this to me is the surprise sector and a very big key to the overall market. Number one is we know that retail, brick and mortar retail, as in the case of this, has lagged for years. Even as the rest of the market was peaking, this was still struggling. And now what's so interesting is even with the swoon, it's come back, and where I just showed you with the small caps that were kind of more at a 50% level from top to bottom, this is sitting here consolidating very close to the high before the actual market crashed. What does this mean? This is the ray of hope for the economy. We are a consumer-driven economy. Retail is 70% of the gross domestic product. So as far as I'm concerned, this could be the one that wakes up and leads. And even though we're seeing businesses close and stores close and restaurants close or not reopen, it's still right now a situation where people are spending money, spending stimulus money or saving their money to spend their money. And then of course, once they go back to work, just the human psychology here is in play. People don't like to go without for very long and have no trouble going into debt either. So I like the fact that this is behaving very well, and this has been the one thing that has kept me from getting bearish right now. Now, right here, just put some numbers on it. If we break down under 40, yeah, that would definitely be a situation to believe that IWM has already broken down and Granny Retail is next and consumers are starting to get nervous again. But on the flip side, if we break out over 45, that to me means that this could be the big shock and surprise of the summer, and especially if we're looking at the virus fading by the end of the summer and people looking forward to going back to school, back to work, which, as you know, is a big shopping season. Now, the next one is transportation. Now, this is troublesome, even with FedEx coming out with some very strong earnings. This also includes airlines, which has not been doing very well, although United Airlines did come out and say that they're going to increase their flights for August. So once again, there tends to be optimism. And of course, as I've said many, many times, what makes us human beings and what makes us survive is our ability to hope. So with this one right here, this would be considered one of the weaker ones, getting ready for actually a death cross on the weekly chart, and that's when the 50 crosses below the 200. However, it's still in a range. So I would be generous with this, and I would say if it goes down to 150 and holds, then that would be a good opportunity to maybe look at some of the stocks, particularly if retail starts to do better. And on the flip side, really, we have to give this to 175. So that's a $25 range that we have to watch. And I haven't really looked at the real momentum indicators unless there's something very interesting going on. But right now, this shows no price divergence from the momentum at all. So Transportation is huge because whereas the IWM represents the supply side, this represents the demand side, and there's your disconnect. We see retail sales going up, consumer confidence going up, but things aren't moving, and I think that's mainly because of travel, not necessarily things like trucking, like we saw with FedEx. Now, of course, semiconductors has been on its own fumes, and there's a couple of reasons. So there is no reason for me to believe at this point that tech, whenever it dips, is probably a good buy opportunity, unless, of course, we see something so dramatic happen with the virus. And that, to me, would mean only one thing, and that would be the death rate. The death rate would have to start escalating percentage-wise versus how it did during the first wave of the virus. At this point, we're still seeing a very low death rate, and that, to me, is extremely encouraging that this will then continue to trade in its own universe, and that is that we're becoming even more and more a tech dependent society. And so look at what you're seeing here on this weekly chart. We are very close to breaking out to all new time highs again, and that would be over 155. And where would I get cautious would probably be under 139 right here. 140 to 139. So again, we're in this range. It's choppy. That's why the market's probably been hard for a lot of people to figure out here, unless you're an incredible stock picker. But I think at this point, we should be looking at buying the dips and selling the rallies. And of course, all of this just until, as I said, we get closer to October, as we start to wonder what's happening with the actual election, and then people start getting nervous about a change in administration. Now, of course, this continues to do very well on the momentum right here, as you can see. Let me find my pointer. Here it is. As it's holding above that 200-day moving average very well. But what's interesting here is you had the peak, when you had the peak price up here, and now we're not that far away, and this momentum is nowhere near there. So the momentum has waned along with this choppy trading range that we're seeing. With biotechnology, of course, this also is going to be and will continue to be a promising sector as we go into the second half of 2020. Today, there was some huge news, and I should say today, but there has been huge news on Pfizer as a potential with good results on their vaccine trial. We're probably still 6 months at least, maybe not till a year and a half away from having some sort of vaccine, and of course that would really be awesome. But in the meanwhile, just the fact that biotech has outperformed after it peaked in 2015 and underperformed kind of gives me a foreshadowing of what could happen with retail, by the way, because it's the same kind of thing. But now here we are. We made a new high just a week ago, and now I think what's going to happen with this one again will be some consolidation. I know we'd like to see it hold around 134, but I would be a little generous and say 130 now to 140, so about a $10 range is the choppy range we should be looking for, and then see what happens over the next few weeks. And again, what happens as we get closer to that election time. Now, of course, the biggest laggard of all has been the regional banks. Regional banks has a couple of problems. One is, even though people are putting their cash in the bank, probably at the highest percentage we have seen in a very long time, something like 30%, the issue is, of course, that people aren't taking that money and building businesses, or borrowing money for home improvement or sending kids off to school or what have you. And so that's really been a factor, that and low interest rates, of course. But also this is very tied to energy. Regional banks and energy are very closely related. And so even though the oil prices are much higher than they were when we had that unbelievable fallout, they're still not really doing great. Now, I did a whole segment on this on last Friday that I did a segment, because it's a very interesting sector to me in that we're having an inside week. So we haven't exactly failed yet. And of course, at this point now, really, we would need to see KRE get past 40. And we really want to see this get down to 30. So we can be generous with the $10 range. Once we break down under 30, it would be very hard to be bullish in anything, because that might be a real big flash that things are going to deteriorate long before October, November. But again, that doesn't mean that it will deteriorate October, November. It just means I'm anticipating that, because as we know, price rules. And if we're trading up at around 50 by then, which is possible, then that would at least give me reason to say, if you're long and you're enjoying your money, take some serious profits. Okay, so now let's move on. Now that's the modern family, the macro picture, and you can see how much it reflects just the diversification of the whole market in general. So we've got the tech strong, the biotech strong, the Russell's kind of trying to figure it out. We've got the regional banks doing poorly, IYT hanging on for dear life, while we have this incredible bright spot of the retail sector, which is a good thing, by the way. It's a very good thing, because that's an insight of the market. But there are a couple of other sectors we want to watch, and there's been a lot of discussion on cannabis, so let's talk about that as well. So first, a while back I did a segment and I talked about the Vanguard small cap growth stocks. So at the time I gave you Zebra, which rallied like crazy. I gave you HubSpot, which we're going to take a look at in the moment, which is near all-time highs, and that I gave you also the ETF that houses a lot of these small cap growth stocks. So this is different than IWM. This is strictly growth, no value in here. People who are saying value is doing better than growth are just wrong. Growth is still dominating over value big time. And that, of course, also is a little bit of a problem longer term, but that's not necessarily something we need to discuss right now. What I want to show you with this is look how well this is holding up on its weekly chart. It's well above the 50, very much well above the 200. You got positive slopes on both. You're doing very well against the SPY. And the momentum is waned, of course, after we made the peak high. Here was the peak high here, by the way. So we're off from that and we're off from the momentum. The next peak high was here. And we're not that far off from there, but yet our momentum is down, but it's still holding. So this to me would be an unbelievable place for you to continue to look what's in the basket of VBK and try to determine what might be setting up. Or if you just wanted to look at VBK itself, I think right now, again, looking at range bound type stuff, we're looking at 185 and then really like around 202. So again, a big range and lots of reasons to get chomped up right in the middle. Now another one is the actual Russell 2000 growth. So the VBK is more small cap growth. This is anything that's in the Russell 2000, but they're growth stocks. This is a very interesting ETF, one that I personally just discovered recently. Not quite as strong as what we just saw with the VBK, but still looking pretty darn good here over the 50 and over the 200. I don't use a 10-week. I just left it here because it was left over from my daily chart. So that's why you're not going to hear me address it. But again, major consolidation in a bullish phase. So that gives us another range to look at. We're looking at a range of 190, really basically to 210. So I know it's very frustrating to try to watch these ranges and be patient, but if we're looking out for the second half, that's the whole reason why I'm doing this, is because you can know as we're getting into the second half, you might get this nice pop, let's say, through 210. But as we get closer to the fall, you might be taking your profits. And at the flip side, if I'm dead wrong and the death rate goes up and the virus goes out of control in the next few weeks, you break down under that 190 level, then you certainly would want to at least be protecting yourself, looking at risk-off instruments, but then trying to figure out when would be the next buy opportunity. And of course, that to me would probably be more like at around 175, 180. All right, now let's move on from here. Since I wanted to show you one of the VBK stocks that I presented a few weeks ago, this is HubSpot. So HubSpot is a marketing, sales, and customer service software technology, obviously in very big demand and doing extraordinarily well. When I talked to you, by the way, it was down here. We talked about once it cleared 170, 171, 172, it was a buy, and look, it's gone up. it's trading now at 232. Actually, it closed even higher than that today, as I'm talking to you, but around 232.60. So again, this is, forget about a range. This has broken out of the range, but it's a very good reason why we want to continue to look at this sector going forward, but with the eye that a lot of these have outperformed, like Zoom, for example, because of the stay at home. And if things get better over the course of the next 6 months, and the second wave doesn't necessarily materialize into a lot of deaths, and we don't see even what people are calling a possible next wave as we get into the fall, then I think these might be peaked out at that point. And that's kind of what I think retail is relaying, is the hope that the economy will switch. And you know, another thought I had about the retail, I just want to say, is that we've been an online shopping society, obviously Amazon being the pinnacle of that. But at the same time, when you've spent months at home, people love to go out. And so it's possible that that's why we may see brick and mortar retail doing better right here, even though we've had dismal results from Macy's, etc. It could be at some point people will be so excited to go to the malls, and maybe, you know, the market being forward thinking and price sometimes running ahead of itself is what we're seeing, which is why I'm saying these sort of stay at home tech things could become peaking out as XRT starts to move up. Now, another sector I don't think we can forget about is solar energy. Again, a few weeks ago, I talked about solar energy. I gave you SEDGE. I gave you JKS. We talked about First Solar as being the granddaddy of that. And so I don't want you to forget about solar energy, because this too is at about 50% of where it was after the big swoon. Well, more than that, it's really more, almost like 70%. So this is something that closed strong today, even though IWM had sold off. So this is on its own fumes. And to me, at this point, I wouldn't be buying into resistance, but I would be looking to see if TAN and some of the solar companies continue to go up. This through 40, I think, looks very, very compelling. And of course, on the flip side, at this point, I really want to see this hold around 31. So again, a big range, a $9 range. But solar energy is a megatrend that is not going away. Now, let's move on to cannabis. And I threw cannabis in because it is so undervalued, and, you know, for obvious reasons. We still don't obviously have legalization on a federal level. We still have banking issues on a federal level, etc. But more and more states are either decriminalizing or looking at legalization. And Biden, and this could be one of the bigger boons for the market, has talked about if he got in, he would be looking at legalization of pot. So even if the next administration legalizes it or not, the trend is definitely here. And I think will continue, especially as the younger generation starts to become more of an influence in terms of law. But nonetheless, just looking at this from a strict technical standpoint, I really like how this had fallen down, had a big reversal week here after the peak low, and has been consolidating, move up, consolidating, and to me looks like now if it can hang on here, this is MJ, the ETF, at around 13, and the market holds up, I think you have a tremendous, very low risk opportunity here. I wouldn't risk much more than about, let's say, 12.50, so 50 cents on this one, because you're either right away or you're out. If it can hold here around this 13, I think if we can get through 15, then we're going to go see a move back up to 18 before we reevaluate. But I'm very, very keen on this sector, and there has already been more and more scientific research about how this has helped, at least with some of the symptoms of COVID, among many other things, of course. So I wanted to show you a stock in this space that I haven't shown before, and this is GW Pharmaceuticals. This is a big stock. This is a $127 stock. So you can see that it's outperforming on the weekly basis what we saw in MJ. It's having 2 inside weeks, which means this week here was inside the week before that, and so far this week here is inside the week before that. Talk about your major compression. So when you get that situation, again, you have a clear range, looking at around 120 as your support level, and looking at really, say, let's just use round numbers, 130 as the breakout. If this breaks out over 130, Having a $10 risk in a $127 stock is not a bad thing. You then probably would see this thing move up, and that would be good for the overall cannabis space in general. Not too long ago, as you can see last year, this was trading all the way up here, up closer to $200. So keep your eye on this as well. Now let's move on to emerging markets in China. There's been a lot of articles out lately about the fact that emerging markets are starting to outperform the US markets, and there are many, many reasons for that, one of which is definitely the handling of the COVID has been better in some of these emerging markets. But what are emerging markets? We're talking about, believe it or not, China, and I'm going to show you that chart separately, but Russia, Brazil, Italy, Vietnam, which I featured a few weeks ago, and then Thailand, India. So these countries are definitely worth looking at as we're getting into the second half of the year, especially since they'll be influenced by the US market. But if we don't have a full-blown swoon, can really start to continue to outperform because they're not going to have the same type of geopolitical situations that we have here. There have been social unrest, but nothing like what we're seeing here right now. So this is the ETF that represents that. And now you can see the same thing. We had the big week here, and we've been doing nothing but consolidating since then. And the 50 is touching right down on the 200 week. So once again, we want to look at a breakout over 41. All these things are so range bound. And really, to give it a little bit of room, we want to look at support at 37.50. But right now, we're spending our second week above both of the moving averages. We were outperforming the SPY. We've come off a little bit. But the most concerning thing for me right now, that's why I would wait for a breakout over 41, is that on the real motion, we're still under that 50-week moving average, even though we're clearing it here. So it's telling us that the price is clearing, but the momentum isn't convinced yet, which is why it tells me if this actually starts to move up in momentum through 41 wouldn't be bad. And then looking at China right here, that actually looks a little bit better, not only on the momentum. Let's start with that, because this is actually back over, well, no, it's not back over the 50. I'm sorry, it's back over the zero line. Here's your 50-week moving average right here. It's trying, and again, there's a divergence where the price is actually holding. But once again, there's a big range here for us to look at, 39 being the bottom line support, and then again, about 41.50, almost the same numbers here, as being the place to break out. And plus, if we just compare the whole move down to where we are now, where IWM was sitting at around 50% between the high and the low, this is over 50%. So that's where you want to go. You want to go where you can find the least amount of risk, something that's outperforming, at least on the IWM, not necessarily on the SPY. And again, you want to make sure that you see the momentum starting kicking in as well. And also, as I said, as a trend, emerging markets to me is one of the more interesting spaces to look at as we get into the second half of the year. All right, this is big. This is the Fed and the dollar. So here's what's happening with the dollar. The core of the whole situation with the Fed is this. They have been borrowing money to buy these high-grade corporate bonds. They have been buying money to buy junk debt. And so when borrowing money, so what they do, where do they get the money from? They have to issue more dollars. And so what that does is it forces the public, when the Fed starts buying these riskier instruments, it forces the public to buy the riskier instruments as well, which adds general risk, not just to the whole overall public, but most importantly, to the US dollar, because more dollars get printed along the way. And as we know, the money supply has already surged. And so this is a chart of UUP. I've shown you other charts before, but this one to me is very interesting because this has clearly on the weekly basis broken down. It had peaked here. I have been negative on the dollar for a while, but I really believe that if the Fed keeps doing what they're doing, and let's face it, don't fight the Fed, and that's one of the reasons why the market is holding. The other great opportunity going into 2020, besides maybe consumer retail saving the market for some reason if she puts on the Wonder Woman jacket that tech has been wearing, and the emerging markets and possibly cannabis, would be the stagflation, which we're about to get to because of the scenario that the Fed is creating. So here we go. If this can't get over 26.50, And you can see so far we're having an inside week. I see no reason why we can't go down to 25 very, very quickly, which, considering how small this UUP is in terms of its average range, would be a very big move down in the dollar. Now, we also have to look at the bonds, because that's what the Fed's been buying. So these are the high yield corporate bonds, HYG. But the Fed came out and announced specific companies that they have been buying in this area. However, this actually also, again, if you look at it from a perspective on a weekly basis, is more than 50% above the range from the high to the low. That's because of the Fed. However, it is back under that 50-week moving average right here. Now, I don't necessarily advocate trading this. I mean, you certainly can if you want. I like to use these bonds, since they've been such a hot topic, as information. If we're looking at don't fight the Fed situation, you don't want to see these bonds collapse, because it means that the Fed has diminished its bond buying program, which I don't think is likely anytime soon, but you never know. And so rather than guess about it, just look at this. So if it can get through 82.50, that's probably going to be good for the market. And probably one of the reasons we're seeing choppy conditions is now this has come off over the last several weeks. So I would be looking to see what happens here with this high grade, high yield corporate bond buying program that the Fed has announced. And if we can get through 82.50, that would probably give another juice to the market. But on the flip side, if this starts to break down under 80, let's say, then that might be a reason to start also being a little bit cautious. And of course, we're not seeing this do anything as well as the SPY, so there already is starting to be a little departure in the relationship. I can't even tell you if I think that's a good thing or a bad thing. It's just a thing and a reason to watch. But we also have to look at the investment grade corporate bonds. So these are the high-flying companies that the Fed has actually done some investing in, like, for example, Berkshire Hathaway. And so this looks just the opposite. So instead of the high yield debt, this is actually the bonds themselves. And look at this, new all-time highs. So this is another one where I wouldn't necessarily trade, but it's great information. So what it's saying right now is that the Fed is buying the best stuff. And they're doing that for a reason. Can they keep doing it? Remember, it could affect the dollar longer term in the stagflation. But for now, as we're getting into the second half of the year, the party is still on until the party stops. And that's where the stagflation theory really comes in. So of course, to complete the picture now, we have to look at the actual TLTs, or the 20-year Treasury bonds. And a lot of people will look at this for a risk-off situation. But right now, this hasn't really done very much since it had this explosive 2 weeks, really from 140 to 175 in the course of 2 weeks, or I should say 175 to 140 in the course of 2 weeks. And all we've done in between has been in between that particular range right here. Now, my guess is that I would not be a buyer of bonds right here, really, until it took out 170. And by the way, this instrument I have traded and don't mind trading. Haven't done anything now, but in case, especially as we get closer to that fall period of time, if this gets through 170, that might be an opportunity to take advantage of anything that happens that could really disrupt the market. But for now, I'm actually anticipating that this can actually go down, and if it breaks under 160, I would not be surprised to see a move back down closer to around 150. But what it's saying is that the yields would be rising a little bit, and ultimately, there's a point where that's good for the market and a point where it's not good for the market. It's good for the market because it means that there may be a little more confidence in an economic recovery. It's bad for the market, though, because if the yields get too high, the market gets spooked. So this is a very fine dance, and I like to show it. But the biggest thing, really, the takeaway that I'm watching in terms of the Fed is really what happens with the dollar. I almost think, and I'm going to be bold on saying this, that what happens with the bonds is second to what happens with the US dollar, and that's impacting in terms of what we're going to talk about now, which is our last theme, which is stagflation. Now, again, I did a segment a long time ago, a couple of months ago now, where I compared the 1970s to what's happening now. Because what happened in the 1970s is you had geopolitical problems in the mid-70s during the Nixon administration. You had a war, although we don't have a war, but you had the war, first of all, with the Yom Kippur War in 73. You also had the Vietnam War ending. And you had a tremendous amount of uprisings as a result of the Vietnam War. And then from there, what happened was you had the Fed come in and actually lower the rates. And then after that, you started to see inflation coming in to the point where it went out of control by the end of the 70s. And that's when Volcker came in and started to raise the rates to control the inflation, which then led to 1982, 1983, which was the start of one of the greatest economic booms that we've seen, so certainly in our lifetimes. So the 70s now are kind of what's happening right here, which means, again, just sort of comparing here, we're in for some bumpy road. And everything, by the way, is accelerated in time. It's not even years anymore. It's in a matter of months. We're in for that bumpy road, and we're starting to see a stagflation scenario emerge. But at the same time, we could see that then lead to an economic recovery that's for real and not one that's been stimulated by the Fed as we go into that February 2021. So let's take a look at silver. And the reason why I have silver here is we know gold's done well, and I've talked about gold a lot. So I wanted to talk about silver a little bit, because there are two things you want to look at in silver. One is you want to look at how it performs relative to the gold. So it has been underperforming the gold. It's starting now to pick up a little bit in terms of its performance to gold. But the key is that in the gold-silver ratio, when silver starts to outperform the gold, that means inflationary factors are starting to hit the market. We had a golden cross here in silver. The big area, really, 17 is an area, and it stopped here at 17 and is consolidating again. But actually, if you really want to see the biggest area, and one thing I've learned about commodities, don't be afraid to buy them on strength when things are going crazy, would be through the 1745, 1750. And we can get through this. I think we're going to see in no time $20. Where would I be risking at this point? It would be like 16. I think the silver, if it's any good, should hold between 1590 and 16. And look at how well the momentum is increasing here as well. So silver, gold, of course, if it clears 1800, it went up there and tested it. It could go up a couple of times before it actually clears. Also inflationary, but really, if you want to look at stagflation, silver is the better way to go. Now, I also talked about DBA. And I talked about some of the ETFs that are related to agriculturals, because I really believe, and I still believe, that the biggest opportunity for the second half of 2020, other than the emerging markets and a couple of other things I've already mentioned, is food commodities. A couple of reasons. One is deglobalization, which has been happening, means that countries will be hoarding food for their own food supply and not necessarily sharing with the world. Number two is we've had food chain disruptions. Number three is that the USDA reports came out recently and farmers have been planting less, no surprise there. And number four could be any kind of environmental concern, like a summer coming up where drought hits. So all of those would not only be good for the food agriculturals in terms of a buy opportunity, but it would be kind of bad in terms of A, what happens to the consumer's wallet as they start to pay more for food, but also B, what would also mean for the dollar, because it would also mean that stagflation is happening and so your money buys less. But again, we don't have to worry about all the social implications or even the economic implications. We want to make money. So that's why I keep focusing on this. And the reason why I brought this one up, this is the yield diversified commodity strategy. So basically what this is a fund from Invesco, and it doesn't have the same K1 problems that if you're trading DBA, for example. Look at this chart. This is a weekly chart. We are just one little sneeze away from getting through these highs right here, which is at about 1310. You get a weekly close over 1310. First thing that'll happen, of course, will be to fill this gap. And if that gap gets filled, then there's no reason to think that this would go up to 1450 at the 50-week moving average and eventually test around 16 before, we take another fresh look. But I really like this over 1310. I think you have a pretty tight risk to about 12.35 on this. You can see we are nowhere near net outperforming the SPY. And of course, we're increasing in momentum here, but there's been no divergence. So keep your eye on this as a way if you want to avoid having to trade some of those ETFs that give your K1s problems. But I did want to show you soybeans because I've talked about soybeans with you. I told you I'm in soybeans. I'm still in soybeans. I'm actually really just very close to actually taking a first profit target, which I like to do even if it continues to go up. And then I hold the rest of the position. Our profit target area is right up here at 1444. But we've been long soybeans since 1374, and I came on and told you about that. And the major reason why was because I was starting to see at the time that we were getting a good consolidation. We had a nice bottom to trade against, and that even though it was underperforming, I started to see the momentum starting to really creep up here. We got in right around here just when the momentum was clearing that Bollinger Band right here, and we still haven't cleared that 50-week, but it looks like it's going darn close to that. So that tells me that soybeans is another one to really keep an eye on. And then the last one I'm going to show you here today is cane. I always like to end with cane. This is sugar. I'm not going to show you sugar futures right now, but sugar futures trading over 12 cents is not bad. But I've talked about this over and over and over again because it's the secret inflationary indicator, in that people during rough times, by the way, will go to sugar. They will buy junk food. Certainly during COVID, I know people have been buying junk food, but as a general rule, the lower socioeconomic groups will turn to sugar. And also in the 70s, sugar was the first commodity to go up even before gold. It was the warning. It was the canary in the coal mine, so to speak, for inflation coming, or in that case, stagflation coming, and that's why I'm looking at it again. So now to put some numbers on it, it's really done well. I think when I came on the show last time, I said it had to get through 580. That's now through that. So I think we're in the buy zone here. Over 6, obviously, on a weekly close would look even better. And I don't see any reason why you don't need to risk more than under 550. And I think this 50-week moving average can be taken out pretty easily on the basis of the fact that we've now had several months of consolidation from its low to where it's trading now, from 5 really to 6, about $1. So that would tell me that we could at least get to 7, about $1 move, and if things get dicey and that dollar goes down, we can get up to 8 pretty quickly. So that's it. That's a lot. So just to sum up, really basically what I'm saying is, in equities, keep your eye on consumers and keep your eye on the retail. Keep your eye on emerging markets. Also keep your eye on the regional banks, not to spoil the party for everyone. Keep your eye on China, especially, and some of those Chinese stocks that we talked about in the past. Keep your eye on the solar energy sector as well as we get into. Keep your eye on cannabis, because that has been an underperformer that can start to come back. And keep your eye on the dollar. Kind of what the Fed does, but watch those interest rates maybe to strengthen a little bit. And then last, but probably most important, is keep your eye on the food commodities, silver-gold ratio, and look at that possible stagflation scenario to emerge as we get into 2020. Okay, please ask me questions on YouTube. I'm always happy to answer them. Thank you so much for watching this very extensive, but it was good for me too, because it gives me a roadmap and a plan for as we get into the rest of the year. Thank you again. Bye for now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.